Key difference is back in 2008, we didn't have the magic cowbell. We didn't have money printing. So interest rates are a slow, blunt tool. Money printing is instantaneous. So I think everybody was shocked by what happened at COVID. They shut the entire world for 3 months. The market went down for precisely 4 weeks and then rocketed going forwards. Why did it rocket? Because if you deflate the price by the amount the balance sheet went, it was just debasement of currency. I don't see how you can have 2008 once you've got the money printer.
About a week ago, Real Vision founder and CEO Raoul emphasized the crucial role of the global liquidity cycle in influencing asset prices in a tweet. Powell observed that the ongoing global liquidity cycle has already resulted in a 50% gain in the NDX and a remarkable 150% surge in Bitcoin in 2023. Anticipating an acceleration in liquidity in 2024 and 2025, Powell's insights are derived from the Everything Code. Powell's Everything Code thesis revolves around establishing an interdependent connection between central bank balance sheets, particularly the Federal Reserve's, and asset prices. He argues that the global economy faced a pivotal moment in 2008, which should have been catastrophic, but central banks intervened to prevent a collapse. As long as central banks can continue printing money, Powell contends that the fate of the global financial system will remain strong, awaiting a more enduring solution. The initial focus of Powell's thesis addresses more immediate concerns such as currency debasement and inflation. According to the Real Vision CEO, investing is the key to keeping pace with or outperforming the devaluation of the dollar and other fiat currencies. Powell suggests that while most assets can help maintain value, only cryptocurrencies and tech stocks will truly outperform. This strategy, he believes, acts as a safeguard against recessions or economic declines, as long as central banks can continue their monetary policies, resulting in appreciating asset prices with crypto and tech leading the way. In a recent interview with Banter, Powell and macroeconomist Henrik Zeberg discussed the merits of Powell's thesis, particularly in contrast to Henrik's projection of an impending recession in 2024.
Hello everyone, in today's promotion, we will be looking at Africa Rare. Africa Rare, as one of the pioneers of the state-of-the-art, a highly powered mixed reality platform, committed to crafting a metaverse that honors African ingenuity. This immersive 3D virtual environment, fueled by Polygon blockchains, flourishes as a dynamic digital realm where creativity, cryptocurrency, and commerce seamlessly intersect. Now let's look at the Ubuntu tokens, serving as the currency and the Ubuntu land operating on the Polygon blockchain. This adaptable token grants access to all facets of Africa Rare, enabling activities like buying, developing, selling, or leasing plots within the Ubuntu land, as well as acquiring digital goods and services within the virtual world. To become part of the Ubuntu token allow list, secure your Africa Rare OG Private Pass NFT. OG participants joining the allow list will be granted an exclusive access Private Pass NFT, which will be staked for a Ubuntu token rewards during the token generation event. They will capture a snapshot of the first 10,000 allow users who will be able to be qualified, obtaining the OG Private Pass NFT. This NFT can be staked in your user profile to earn rewards and traded on the secondary market. So what are you waiting for? Click on the join list by clicking on the bottom and sign up with Africa Rare.
So this is global liquidity from all the major central banks, the Fed, the BOJ, the PBOC, the ECB, and the Bank of England. And basically, they were all withdrawing liquidity, but I noticed that liquidity had bottomed in year-on-year measures and other forms back in. It actually started bottoming in June, which got me into starting to rebuy Ethereum in the lows there, and then fully confirmed the bottom to me in my measures in October, November. So that's when I really kind of loaded up in technology and the full crypto. And for me, that these are forecastable, readable cycles based around the debt refi cycle. So for me, that's why I've got a more extended view before a downturn than Henrik has, because I don't see any reason why it won't just continue, generally speaking, till 2025, the end of this perfect cycles we've been having since 2008. So this is the Fed balance sheet in black, and the red is 36 months forward of the current interest payments. what that's telling you is the interest payments are set to explode or are exploding because of the COVID payments 36 months ago, the COVID debt. And what we found, this is the shorter term chart, using the longer term chart since they started QE, basically all QE has been monetizing past debt. So after the 4-year cycle, they just monetize the debt, shove it on the balance sheet, start again. So it's been this endless 4-year cycle based around this. And we've got this ridiculous phase to come where they can't really manage the interest payments without doing something. Right? You can't have rates at 5% or even 4% if you're looking at slightly longer, because the maths don't work, and they've got to keep issuing to pay all the interest of the 10 trillion or whatever they have to roll over the next year or two. So, for me, that's the liquidity cycle, and you do that, and assets go up because you're debasing the denominator, the currency. So what happens is when you issue debt, you've got a fixed interest rate that you've now pay, right?
Yes.
So 4 years ago, this is all done at nearly zero. So if they've gone from, let's say, 1% to 4%, right, that's a 300% increase in the cost of paying the interest alone.
There's no way they can afford it.
The numbers of the interest payments are so big now that interest payments are now larger than defense spending. It's bananas.
Okay, so what happens next? So how is the US getting out of this?
That's been my core thesis for this everything code cycle, is they've done the same thing every time. The economy slows down because rates have gone up and there's so much debt. So fine, the economy slows down a bit and they use it. It's the same time as the election cycle as well. It's all the same cycle. Bitcoin halving cycle, it's all the same time. They get interest rates down and they engineer some way of using the balance sheet. Who the hell knows how, what reason, but that's generally what they do. And that's why election years tend to be pretty good years, which is why this is why, and I'd love to hear your view, Henrik. That's why I still struggle to get bearish for 2025, because even if the economy slows in an election year, they'll just stimulate more. And that's the struggle I have, is that, if you have a blow off top and some, I've seen some of your stuff, like you could have a 1929 style thing. I'm like, I don't think you can, because they just print money and optically it debases the currency. So how do you get that?
While Henrik's short-term outlook is bullish, he adopts a more bearish stance for the longer term. Henrik advises caution against excessive optimism regarding liquidity and the central bank's ability to maintain stability, particularly considering the substantial debt accumulated over the past 15 years. He points to prevalent weaknesses in the housing market, typically a significant indicator of an impending recession. Henrik notes that the delayed recession is primarily due to the robustness of the U.S. labor market, but he anticipates a shift in this scenario. According to Henrik, companies, spurred by generous stimulus packages and expectations of a prolonged economic boom, built up capacity after the lockdowns. However, the actual economic reality has fallen short of these expectations, leading companies to hold off on utilizing their full capacity in anticipation of stronger demand. Henrik predicts that in about 6 months, companies will reluctantly start laying off workers in large numbers. He foresees that when the recession eventually hits, central banks will inject substantial liquidity to avert disaster, inadvertently worsening the situation and contributing to an extended period of stagflation. Raoul offers his response to Henrik's thesis.
I look at the housing market, and year on year, the rate of change of housing is actually now stabilized and sort of rising with the forward-looking indicators for ISM. And also, most of the interest payment charts, a lot of that is mortgages, and the mortgage stuff is fixed rates. So there's actually a very small amount of that seems to be an issue going forward. So I'm not overly concerned by that. When I look at the business cycle, I use the ISM survey, Institute of Supply Management. I've got that goes back to 1947, and you can use the Treasury survey that goes back to 1870. Works pretty well. Gives you a decent idea. So here's how I'm just using my recent GMI monthly, and I haven't got all the full economic charts in this, but basically there's a very nice cycle, which is the top chart in black, which is the ISM. And this is everything code every 4-year cycle, or every 36 months. Now, when the ISM gets below 50, you're starting to look for a recession. It's been below 50 all year. Most of the forward-looking indicators were showing this all through 2022, that we should be slow now. Now, the question is do we get some other events that, ignoring the COVID, is there something that could create a weaker economic cycle than regular, considering the Fed are now stopping the rate rises? Now, they did that also in 2008, somebody might say. But the point being is, what is the systemic shock here that causes a freeze up of the collateral system that can't be solved by liquidity? So if I look at the forward-looking indicator just by using the ISM alone, just inverting it, because it's such a perfect cycle right now, we've been following this pattern all the way. So my idea of the business cycle, and we use financial conditions index and several hundred charts based around the business cycle, actually several thousand, is for us, the business cycle just gets stronger from here on in. That whether we got a recession or didn't get a recession, it was priced into growth assets last year in 2022. And in 2023, it got priced into stuff like the Russell 2000 and cyclicals. And I think most of it should continue higher. So I don't really see the evidence of it being a late cycle. That, to me, if I look at this chart, that looks like we finished the cycle. The forward-looking indicators, stuff like ISM new orders to inventories has been rising. That's always signaled the bottom. The new orders has signaled the bottom. So I'm pretty sanguine about the risk of something larger happening here that could derail the economy.
What you saw back into was absolutely, as you said, the Fed, I think they stopped the rate hiking cycle in 2006 already. And as you said, they tried to manufacture again, the whole business cycle. And what we saw there was that by the end of it, we really saw that it was the housing market, the deterioration. And I know we had speculation around that time in the housing market. But we also do have speculation today.
Yeah, but the key difference is back in 2008, we didn't have the magic cowbell. We didn't have money printing. So interest rates are a slow, blunt tool. Money printing is instantaneous. So I think everybody was shocked by what happened at COVID. They shut the entire world for 3 months. The market went down for precisely 4 weeks and then rocketed going forwards. Why did it rocket? Because if you deflate the price by the amount the balance sheet went, it was just debasement of currency. I don't see how you can have 2008 once you've got the money printer.
According to Powell, all is not lost, and there remains a substantial chance for smooth sailing without severe repercussions for Americans and other countries with robust currencies. Nevertheless, investing remains crucial and obligatory for those seeking to preserve and grow their wealth. Over time, asset classes like bonds may not rise rapidly enough to offset inflation, while popular stock indexes such as the S&P can help maintain wealth without significant growth. However, Powell asserts that cryptocurrencies remain the top choice, and only crypto and technology stocks will consistently outperform the rate of currency debasement. Share your thoughts on the video. Do you concur with the idea that AI and other rapidly evolving technological innovations offer a solution to the world's massive debt problems? Please share your comments and observations in the comments section below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.